Hey there, money savvy friends. Today, we're diving deep into the world of economic myths that might be secretly draining your wallet. Buckle up, because we're about to bust some long standing financial misconceptions that could be holding you back from reaching your full money making potential. Let's face it, we've all heard these economic truths passed down from well meaning relatives, friends, or even so called experts. But here's the kicker. Many of these widely accepted beliefs are actually costing you cold, hard cash. So, grab your notepad because we're about to uncover 6 economic myths that you need to ditch ASAP if you want to level up your financial game. Now, before we jump in, let me tell you why this matters. Understanding these myths and the reality behind them can completely transform your approach to money. It's not just about avoiding mistakes, it's about seizing opportunities that you might have been missing out on. Trust me, by the end of this video, you'll have a whole new perspective on how to manage your finances and make your money work harder for you. All right, let's kick things off with our first myth. Debt is always bad. Now, I get it. We've all been told to avoid debt like the plague, right? But here's the thing. Not all debt is created equal. Some types of debt can actually be smart financial moves that help you build wealth over time. Take mortgages, for example. When you're paying off a mortgage, you're not just throwing money away on rent. You're building equity in a property that could appreciate over time. It's like forced savings with the potential for growth. And let's not forget about student loans. Yes, they can be a burden, but if they're helping you invest in your education and future earning potential, that's a form of leverage that can pay off big time down the road. The key here is to distinguish between good debt and bad debt. Credit card balances that you're struggling to pay off. That's bad debt. A low-interest loan to start a business or invest in yourself. That could be good debt if managed properly. It's all about using leverage wisely to create opportunities for growth. Moving on to our second myth. A strong economy guarantees a strong stock market. This one's a real doozy, folks. I can't tell you how many times I've heard people say, the economy's booming, so it's time to go all in on stocks. But hold your horses. It's not that simple. The truth is, the stock market and the economy don't always move in lockstep. Sometimes, the market can be soaring while the economy is struggling, or vice versa. Why? Because the stock market is forward-looking. It's not just reacting to what's happening now, it's trying to predict what's going to happen in the future. Think about it this way. During the pandemic, we saw the stock market hit record highs while unemployment was through the roof. How does that make sense? Investors were betting on a future recovery and pouring money into companies they thought would thrive in the post-pandemic world. So, what does this mean for you? Don't base your investment decisions solely on how the economy is doing right now. Look at the bigger picture, consider long-term trends, and remember that a diversified portfolio is your best friend when it comes to navigating the sometimes confusing relationship between the economy and the stock market. All right, moving on to myth number 3. Gold is the ultimate safe haven. Ah, the allure of gold. It's been around for centuries, and some folks swear by it as the ultimate protection against economic uncertainty. But is it really all it's cracked up to be? Here's the deal. While gold can be a good way to diversify your portfolio, it's not the foolproof safety net some people make it out to be. Gold prices can be volatile, and unlike stocks or real estate, gold doesn't produce any income. It just sits there, looking pretty. Don't get me wrong, having some exposure to gold can be smart. But don't fall into the trap of thinking it's the be-all and end-all of safe investments. A truly safe investment strategy involves spreading your risk across different types of assets, not putting all your eggs in one golden basket. All right, moving on to myth number 4. High risk equals high reward. This one's a real classic, and it's got a kernel of truth to it. But like many things in finance, it's not the whole story. Yes, investments with higher potential returns often come with higher risks. But that doesn't mean you have to be a daredevil investor to see good returns. In fact, taking on unnecessary risks can be a fast track to losing your shirt. The smart move? Focus on risk-adjusted returns. That means looking for investments that offer a good balance of potential reward and acceptable risk. It's not just about chasing the highest possible returns, It's about finding opportunities that align with your risk tolerance and financial goals. For example, instead of putting all your money into a single high-risk stock, you might consider a diversified portfolio of index funds. You're still exposed to the growth potential of the stock market, but you're spreading your risk across many different companies. Now let's talk about myth number 5. Taxes only matter at filing time. Oh boy, if I had $1 for every time I've heard this one, I'd have, well, a lot of taxable income. Here's the truth. Tax planning should be a year-round activity. Waiting until April to think about taxes is like waiting until New Year's Eve to make resolutions. You're missing out on a whole year of opportunities. By thinking about taxes throughout the year, you can make strategic decisions that could save you a bundle. Maybe it's maximizing your contributions to tax-advantaged accounts like 401ks or IRAs. Or perhaps it's timing your investment sales to optimize your capital gains situation. The point is, a little forethought can go a long way when it comes to minimizing your tax bill. And finally, we come to myth number 6. Renting is throwing money away. I can't tell you how many times I've heard this one, usually from well-meaning relatives pushing young folks to buy a house ASAP. But guess what? It's not always true. Renting can actually be a smart financial move in many situations. It offers flexibility, frees up capital that would otherwise be tied up in a down payment, and eliminates many of the hidden costs of homeownership, like property taxes, maintenance, and repairs. Don't get me wrong, homeownership can be great, but it's not the only path to financial success. The key is to look at the full picture, including factors like how long you plan to stay in one place, the real estate market in your area, and your overall financial situation. Remember, the goal isn't to own a home. The goal is to build wealth and financial security. Sometimes renting is the smarter path to that goal. So there you have it, folks. 6 economic myths debunked. I hope this video has given you some food for thought and maybe even challenged some of your long-held beliefs about money. Remember, the path to financial success isn't about following rules blindly. It's about understanding the principles behind those rules and applying them intelligently to your unique situation. Before you go, don't forget to hit that like button if you found this information helpful. And hey, why not share it with a friend who could use a financial wake-up call? Drop a comment below with your thoughts or any other economic myths you'd like us to tackle in future videos. And of course, make sure you're subscribed and have that notification bell rung so you don't miss out on more myth-busting financial wisdom. Until next time, keep questioning those money myths and stay financially savvy.